welcome to Green Global Real Estate Education Network. As you guys know, we are a real estate education company and also a network marketing company. Everybody here is a familiar face, so we don't have to get into too many details. I guess everyone's a member or a quasi-member. So tonight we're going to have a gentleman who has some very interesting perspectives on investments. He's I'd say, in some respects, a bit of a savant when it comes to analysis and numbers, and seems to have a unique perspective on tinkering with ideas for investments. And so you guys may have seen some of the stuff. He's on our website. Tom Rutkowski is his name. And he gets into high-yield alternative investments. He's also spoken with us before regarding tax-advantage strategies, some of the ways of using insurance, whole life insurance portfolios, and it's for those of us who are making money in real estate. There's a certain point at which we're going to have to make a shift. Money goes out, money comes back, money goes out, money comes back. We buy a house, we sell a house. But at a certain point, we don't necessarily want to work that hard anymore. Or, for example, if you're where we are, we have a certain amount in a company that needs to not necessarily sit dormant, and you want to try to maximize the yield on that. He's a good resource to speak with regarding what to do for that money. And anywhere you are in the game, you should be building funds, building that nest egg, and diversification eventually is something that you're going to want to do. So even though I think most of us here are a little bit more involved in the real estate side of this, we want to definitely keep our eyes open for any kind of investment that has a really strong rate of return. And eventually, we all want it to be more passive. We don't want to have to be actively involved in the management or the procurement. So. Anyway, without further ado, I'll let Tom get started. I'm sure he'll have a nice presentation. Afterwards, we can probably have a little question and answer session. So, Tom, go ahead.
So you've made a ton of money in real estate. How do you keep it? So, advance to the next slide. So these are just some axioms. I had that up before. I'm not sure how much of it you heard or not, but the point is it's ancient wisdom to want to keep your money. A fool and his money are soon parted. Don't put your eggs in one basket. Easy come, easy go. So the purpose of this presentation is to keep the fool with his money, to put the money and put all the eggs in different baskets, and easy come, make it hard to go. Go ahead to the next slide. And what it really comes down to is, is your wealth built on a solid foundation? So is your financial structure the house of cards on the right that's going to come tumbling down? Or is it the skyscraper on the left that's built on pilings driven deep into the earth, a concrete foundation, steel girders all the way up, glass and roof to keep the weather out? Something that's going to build a legacy that's around for long after you're gone. So if we move on to the introduction, what I want to do is just kind of set the stage, what we're doing here, and what I'm going to be talking about during the presentation. So, number one, many common real estate investment strategies are highly susceptible to market changes. And a good example of that is you just take your average house flipper who makes some money on one deal, and he takes the profits and reinvests it into two flips, takes the profits and invests it into four, and Before you know it, he's got a business going where he's got 16, 32 projects going on all at one time, and taking advantage of his expertise and a team of wholesalers and rehabbers, contractors. And one day the market crashes. And now he's got all of his money out in all of his deals, and when the market comes down, so does his wealth. So what we want to do here is show you some strategies so that you can keep it through the next downturn. So go ahead on to the next slide. If you want to keep your wealth through the next economic downturn, you need to allocate some profits to safer asset classes. And, safe and risk are what we want to talk about in this presentation, because to a lot of people, safe implies, CDs and annuities and things that are relatively low earning. But I want to show you that you don't have to give up return. What you can do is keep the returns high, but just lower the risk in what you're doing. Moving on to the third, I kind of already covered that. I'm going to get it myself. You don't have to settle for the traditional investment that probably brought you to green. So if I had the video on, I'd be, telling you that I'm looking at a room full of real estate investors, a lot of whom are probably there because you're fed up with all the traditional choices that you've got. Your CDs and annuities barely keep up with inflation, and then the stock market's so risky that you stand to lose a lot of your money. So a lot of you are probably there simply because you believe that real estate is a way to safeguard your wealth. And what I'm going to do, going on to the next one, number 4, is talk a little bit about financial alternatives. And financial alternatives offer the opportunity to earn superior risk-adjusted returns. So when the concept of risk-adjusted just means, you can have two different investments that both earn 9%. One might be the stock market, which over 30 years has returned about 9%. And then you've also got the standard deviation, or the risk that goes associated with that return. So in any given year, the stock market can lose 15, 20, 30%. You have to weigh that against another 9% investment that potentially is level year in, year out, that's very safe. So the two are completely different. If you can picture a graph with returns on the vertical axis and risk across the horizontal axis, both are just as high as far as the bar, but one is further out, representing higher risk. So you want to be as far up and to the left on that chart as you can be. And I wish I had a better graphic for you, but didn't think to put that in until later. And finally, number 5, investment clubs are the mechanism that for both accredited and, more importantly, non-accredited investors to access the investments of the top 1% out there. I'm going to talk a little bit about that. Moving on to the next slide. The target audience is anyone who wants to build wealth and keep it throughout the full economic cycle. Because on the video, I'd be asking, basically, who is there anybody in that audience that doesn't want to hang on to their wealth during the next downturn? So, the next slide, my story. So who am I and why am I qualified to even sit here and talk about alternative investments and risk strategies with you? I'm the guy on the right. That's my little wife, Liz, on the left. We've been married for about 27 years. We've got 2 grown daughters. I spent 8 years in the Marine Corps. After that, I got a degree in economics from UC Irvine. I've also got an MBA in finance with particular emphasis in investments. I actually did work for Smith Barney at one time, briefly while I was in grad school. So I've been around investments and investing for a long time. I am a real estate investor. Back in 2012, I basically retired early from my other career and moved down to Florida with the goal of buying a sailboat and cruising the world. My teenage daughters at that time put the kibosh on that plan, so we still moved to Florida, but we just used it as an opportunity to reinvent my career. So I founded innovative retirement strategies, and I'll tell you a little bit more about my company later in the presentation when it becomes a little bit more relevant. But moving on to the next slide, Andrea. Financial risk. So we're not here to talk about your health, the risk of a heart attack, stroke. We're here to talk about financial risk. Financial risk is the likelihood of an asset's value to be less than what is expected at the time the owner wants to sell it. And in my business, moving on to the next slide, Andrea, I've got a simple example that I use very often in my job. And I use the example of a $100,000 house, and just 3 different ways of investing in that house all have a different risk profile. And it should be really apparent to you once we get through the 3 different scenarios, which one is the riskiest, which one is the safest, and what the outcomes are based on the scenario. So here we have a crappy little South Florida house. I don't know what the real price is, but I'm just making it $100,000 in South Florida. We're saying that the year is 2006 and the crash is right around the corner. And this house is going to lose about 30% of its value, which is probably on par with what a lot of South Florida did at that time. So the first investor is Bob, and Bob's got $100,000 in his self-directed IRA, and his IRA purchases that property for $100,000. After the crash, Bob is holding a house that's worth $70,000. So he's basically lost $30,000 of his equity. And he made an equity investment. So he took $100,000 of his money and put it into a house, and every percentage drop of the equity was a percentage drop of his income as well. The next one is Fred. Now, Fred, he's been following a lot of the internet gurus and went to some weekend seminars, and they're telling him that he needs to use other people's money for investing. He thinks that's a great idea because he's only got $35,000 saved up. So he goes out and finds a private lender that's willing to loan him $65,000 to get started. So he takes his $35,000 and the $35,000 loan, and he buys that same $100,000 house. Well, after the crash, Fred only has $5,000 of equity left. So the house, he borrowed $65,000, but it's only worth $70,000 now. So he's lost 86% of his equity by utilizing leverage. So the difference in returns for him is quite substantial compared to Bob in the previous scenario. Now the next one, Tammy's one of my clients, and maybe anybody knows me from the previous presentation I gave to the Green Group. A lot of what I do is showing real estate investors how they can leverage a high cash value life insurance policy to invest in real estate. So in this case here, Tammy's one of my clients, and she's got at least $65,000 of cash value, and she takes a loan against that, probably at about prime rate, and she turns around and makes the loan to Fred at 12%. So she's got her cash value working and earning interest in her policy, and she's got this loan that she made to Fred. So after the crash, her loan is still secured by $5,000 of equity in that property, and she hasn't lost any money yet. And this is the point that I tell to my clients all the time, because I get a lot of people that come to me. They discover, they want to be real estate investors because they watched some show on Home and Garden Channel, and they want to be flippers. And they somehow along the way came across the idea of leveraging cash value life insurance, so they call me up. And then it's my job to try and talk them down off the cliff they don't even know that they're standing in front of, and show them that if they're using borrowed money to invest, they probably want to be a little bit safer with it. So life insurance, just like the equity in your house, if you're going to leverage your house to get into real estate investing, you want to make sure you're a little bit safer with what you're doing. And that's the point that I'm making in this presentation. Tammy, in this case, hasn't lost any money yet. As long as she did her underwriting right on that loan, there should only be 2 possible outcomes. Either Fred pays the interest, 12% on that loan every month, even though he's lost most of his money. Or if he defaults, she takes the house, and after she sells it, she still walks away with all of her money intact. So, next slide, Andrea. So same house, 3 different ways of investing. If things had gone well, Fred would have come out the best. By using other people's money, he would have been magnifying the potential returns he would have got. And then what if we add a couple of zeros to Fred's numbers? What if it wasn't $35,000, but it was $350 or $3.5 million? And that's what happens when the investors use all of their gains to scale their businesses the same way. So it's great when the market's rising, but it also magnifies your losses when the market goes down. And, one of the key points is that Tammy is going to make the same in any given market. Whether the markets are up or down, she should be making 12% year after year. And honestly, that 12% is backed up by real estate, whereas if she had done her underwriting properly, she should never, ever lose money. Now, it's not to say it's not risk-free, but she's doing a lot to mitigate the risk. That's one of the key points here. So which approach is right for you? Well, it depends on what your goals are, what your risk tolerance is. Moving on to the next slide, Andrea. So the takeaways, one is don't speculate with money you can't afford to lose. And there's a big difference between investing and speculating. Investing is expecting a profit. Speculating is just putting it all in red. Next slide. So you have to look at your business's exposure to risk. Take a look at what you're doing and what will happen if the market collapses like it did in 2007. What if interest rates fall? What would be the impact on your business? And the next slide is think about the money that you can't afford to lose and reallocate those profits to lower risk activities. I'm not saying that you have to give away returns. So just like the case with Tammy, I don't think anybody would argue about earning 12% on their money as long as you're mitigating the risk. And then finally, under takeaways number 4, risk is a number, not a concept. So in this example, I gave you 3 different scenarios. I told a little story, and I kind of illustrated the spectrum of risk from highly leveraged all the way through a debt investment. But risk is a real number that you can calculate. So, whether you're looking at annual returns for the S&P 500 or annual returns from an equity fund that you might be considering, risk is a number that you can calculate. And that's how you evaluate your investment opportunities. It's not a concept as I've described here. I mean, again, if you take a look at 2 different private lending opportunities, they both may have a 12% expected return, but one might have a better loan-to-value ratio than the other. You've got to understand what goes into that risk calculation. So moving on, I'll talk a little bit about my business, innovative retirement strategies. Whenever I introduce myself to someone and ask me what I do, I just tell them my business is innovative retirement strategies. And if I don't say anything more, then it usually prompts the next question, which is, well, what's innovative? Well, in the case of financial professionals, innovative is not traditional. Every financial professional out there is basically selling you the same products. The bankers want to sell you CDs. The insurance guys are selling you annuities. And the financial advisors want to put you in the stocks, bonds, mutual funds, or put your assets under management. And the thing I'm going to ask you in the next point is why are you sitting in this room right here, talking about real estate? It could be that you're quite disappointed with the other choices that you've got out in the market. CDs and annuities barely keep up with inflation. But if you do get into something that has potential for higher return, you've also got the potential for great risk or great losses as well. I can't think, with as well as the market's doing right now, if you take $1 million and put it into the market right now and expect it to keep going up, I think we're all a little bit nervous about doing something like that. So who's talking to you about real estate? Of all the financial advisors that you've got, financial professionals, who's talking about real estate? And taking that a step further, who's talking to you about financial alternatives? When I say financial alternatives, I'm talking about things like hedge funds, private equity, private lending funds, private placement securities. And who's showing you how to evaluate investment risk properly? So if we move on to the next slide, Andrea. financial alternatives. What are they? You may not have ever heard them, and the key is because the key word in there is private placements, private lending, private equity. Most of these things are things that you've never heard of because they're not allowed to be publicly advertised. Stocks, bonds, mutual funds, those are publicly traded securities. Private securities are everything else. And if you're not an accredited investor, then you've probably never heard of these things or a lot of these things. As real estate investors, I trust that a lot of you have heard of syndications and equity funds and things like that, raising capital for investments. This is the other side of that. So, moving on. Financial alternatives offer a world or a wealth of opportunities for you. The risk profiles of different securities can run the gamut from low risk, low return to high risk, high return. I mean, if you think about it, as a financial professional, I get hit up all the time from people that see my title on LinkedIn or something, and they're real estate investors. It could be a beginning flipper who's trying to access my client base to raise capital for their flips. And at the same time, I might get a call the next day from a hedge fund guy who's trying to find money for his fund. So it ranges. There's a wide range of what people are doing. And I talk to these people, and I get their stories, and some of them are raising capital just to make the down payment and still going out and getting financing on top of that. And then others are raising capital that they put into investments directly. And then others are raising money for debt funds, just like the three examples that I gave earlier. So there's a wide range of different things. So you can almost find a product that can meet any risk return profile. So next slide. So accessing financial alternatives. So earlier I said that these are only for accredited investors. So the SEC, in its infinite wisdom, I guess it's for a good cause. I mean, the SEC wants to protect the mom and pop investor, the unsophisticated person who's being preyed on by financial predators. And in order to do that, they came up with a standard of you have to be an accredited investor to purchase private securities. And the other thing, being private securities, is they can't be generally solicited or generally offered to the public. That's hence the word private. But there is a way for non-accredited, sophisticated investors to access these. And, I guess, I'm getting a little bit out of order here, but the SEC came up with the definition of accredited investor to try and make sure that these types of investments are only sold to people who have the financial sophistication to properly analyze them and understand what they're getting into. But I would argue that income and net worth aren't necessarily indicators of financial sophistication. I know plenty of people, clients, who are young and don't have a lot of money yet, but they're plenty sophisticated financially. And I also know a lot of people with high net worth who are not. So income and net worth aren't necessarily indicators of financial sophistication. And a lot of my goal with my business is to make these sophisticated investments available to non-accredited investors. And the way that I do that is through the investment club. Again, next slide, Andrea. And the investment club is exactly what it sounds like. If you may have heard of little clubs of old ladies who put in $25 a week to invest in stocks and bonds and mutual funds. And honestly, a lot of them have done really well. I know there's one group out there at least who have beat almost every mutual fund out there. But whether it's a bunch of old ladies sitting around having coffee and talking stocks and investing, or some of my club members who are very financially sophisticated and buying private placements, the investment club itself is the same concept. So the investment club is the entity in this case that's doing the investing. So they're either going to be a partnership, or an LLC, a limited liability corporation. But what really differentiates it from a security, going on to the next slide, Andrea, is that in the case of a partnership, everybody is a general partner, and in the case of an LLC, everybody is a managing member. So if you look at the definition of a security, security is when you put your money into an investment with the expectation of a profit through no effort of your own, through the effort of other people. It's something that's passive. Well, an investment club is not you putting your money into an investment. You're putting your money into a company that you're an active participant in, and you're making the decisions on what to put that money into. So over time, the club, from the beginning, is not going to have accredited investor status. Next slide, Andrea. But it can. So the investment club is the entity that's doing the investing. And officially, the definition is that the investment club has to have, or any investment company has to have about $5 million in assets to be accredited, as opposed to the $250,000 income and a $1 million net worth. But, next slide, under Rule 506B, private placement securities can be offered to up to 35 non-accredited investors. And I don't know why they have that rule. It's probably so that they can sponsors can include their friends, family, and other people in the deal. But typically, most financial professionals that offer those securities, as well as the sponsors, don't typically reach out to non-accredited investors to try and find money for their funds. But an investment club, on the other hand, makes a lot more sense to the sponsor to give up on those slots when they know that there's the financial sophistication there, and two, the potential to reach the accredited investor status within a reasonable amount of time. So the next point, 5, my clubs in particular work with Morgan Stanley's middle market groups in New York City, and the financial advisor is there to specifically recommend securities to the club that meet the club's objectives. And if we go on to the next slide, each club, and I've got 4, each club has a clearly defined operating agreement. And in my business, I use that because I have different needs for my real estate investor clients who are also life insurance clients. And I want them to be able to, one, put their money into something that's going to be liquid whenever they need to make premiums for the policy. And 2, I want to create the arbitrage so that when they take a loan against their policy, they have something that they can put the money into that's low risk, high return, and creates the arbitrage between their cost of money, the borrowing rate, and what they're earning on it. And then in general, I just meet people that want to invest in sophisticated financial assets, and the club is the way to do it, so that non-accredited investors can have access to those types of securities. So each club has a clearly defined goal in its operating agreement. And that's, the operating agreement defines what the return expectation is and what the risk expectation is. And that way because here's the other thing. I mean, once you create a club, it's got a life of its own. Each time you add a member, you've got one more decision-making person. So you need to make sure that the pool of investments and everything that matches that risk profile is all the club looks at. Otherwise, it's going to make it very hard to attract new capital to the club. But in any case, the reason I'm pointing this out to everybody is that the investment club is a way, a structure that sophisticated but non-accredited investors can access the private placement securities that you need to reduce the risk so that you can hang on to the money that you make from real estate investing. And if you go into the summary page, Andrea, which I've probably gone a little bit ahead myself, that kind of wraps things up. A lot of what you're doing in the real estate world is risky, and you want to keep that risk. So you want to shift the money that you can't afford to lose out of those risky assets and into something safer. But the key point of what I'm saying is that you don't have to necessarily give up return in going to the traditional assets when there's a lot of alternative assets that you may not have ever heard of that would fit the bill much better and give you a much superior risk-adjusted rate of return. And the mechanism for doing that is, for non-accredited investors at least, is the investment club. So with that, I think I'm about done. On the next slide, you can connect with me on LinkedIn. I've got tons of information on my website. I've got a link there in the presentation so that you can book an appointment on my calendar. And other than that, open it up for questions.
If you don't have what do you have to have to get in the door? How much you have to have for that? For the beginning?
Can you guys hear Lloyd?
Lloyd's asking, how much do you need to get in the door to be able to join a club like that? Which is a great question.
The private placement securities at least have like a $25,000 minimum. I mean, believe me, I can list hedge funds that probably have like $50 million buy-ins, but that's not what we're playing. You know, I've got specific requirements for the at least in mind. You know, mind you, I mean, I'm not. This isn't exactly a self-serving presentation. I mean, the investment club model is something that can be easily replicated anywhere by anybody for just any reason. You just want to make sure that you clearly define what the goals are. But that said, I mean, most of the things require at least a $25,000 buy-in.
Did you say you're a member of 4 investment clubs?
I've built 4 investment clubs. So right, I have an active stake in each one. But I use those clubs for my own business.
And
Hope that makes sense.
Sure. Did you? So I assume you constructed these or have been involved in constructing these as a form of pooling capital for the purchase of real estate investment?
It's a mixed bag. I mean, again, you know, if you go back to the reason people find me on the internet is because they're usually researching internet banking and they'll find places where I've commented on threads or whatever, and they realize, you know, that Tom knows what he's talking about. And usually the people that reach out to me are newbie real estate investors who, again, want to be house flippers. And frankly, I'm trying to talk them out of it, because if you're going to use leveraged capital, I don't believe that investing in flips is the best thing for you. You know, everything that I'm showing you here is what you do with the money that you can't afford to lose. My clubs are designed for high returns with minimal risk. They're what you're investing in, you know. So it's not. You're taking your profits from the real estate investing and you're putting it into something safe. It's a separate asset class.
So pooling capital for alternative investments, not necessarily real estate.
I didn't hear that.
Pooling capital for alternative investments, not necessarily real estate.
I wouldn't say you're pooling. I mean, the best way to think of an investment club is almost like a mutual fund where each investor has a vote in what the mutual fund invests in. So the value of the club is calculated exactly like it would be in a mutual fund. You know, on any given day, you've got X number of units, and those units have a value. So it's a pool, I guess, but
what's the hierarchical structure for decision making in a club like this?
It's equal. Now, to ensure that everybody is on board, you're going to do. I do it based on a supermajority. That way, nobody's going to be too hurt if things don't work out. Everybody, at least there's a supermajority that wanted to do it.
So from your standpoint as a provider, you would hope to obviously have some commission element involved in the formation. And I guess I'm trying to look at the potential members of this group and see, is the advantage in being able to achieve some diversification through having more capital to work with? I mean, as opposed to an individual investor going out and making their own play. I'm trying to put it.
So the key to the presentation was the analysis of risk. Basically, I want everybody to go out and look at your businesses and determine, if the market turns, are you going to keep all your money? If the answer to that is no, then you need to take some of your money and put it into a safer asset class. So that right there is kind of the meat and bones of the presentation. Now, taking that a step further, private lending, the example that I gave, is an easy and safe way for anybody to earn a good rate of return and control the risk. And you control the risk through the underwriting of the private loan, right? If you do your underwriting right, you shouldn't lose any money. So, right there is I've kind of given you a solution, a way to mitigate risk, to the tools at the very least for you to analyze risk and determine what you may or may not want to put your money into. Now, taking that a step further, I'm introducing you to the two financial alternatives, which people may or may not have heard of. But whether or not you've heard of them, they're really only available to accredited investors. So I'm giving you one more thing, which is the investment club model, which is a way for non-accredited investors to have access to the investments of the top 1%. I mean, in the last 30 seconds, I've basically given you the gist of my presentation, but just wrapped up in a real short summary. So I'm not trying to push anybody towards investment clubs. The whole idea is just choosing investments that offer a high rate of return with low risk.
I'm actually just trying to see exactly how something like this is put together. And you have the one-time buy-in with a fixed number of members, a placement of anywhere from 25 to 100,000, and then you have a goal to achieve a certain amount of capital input, and then at that point it's closed? Yes.
It can be whatever you want it to be. I mean, I'm actively soliciting members, right? And every member is actively soliciting members.
No issue with...
You could do a one-time buy-in, or you could do you can put in every week if you wanted to. I mean, you can structure the club however you want. But the main point is you structure it so that non-accredited investors can have access to investments that are typically available only to accredited investors.
Sure. So if you...
That's my overarching goal.
Even if you are a member, if you happen to be a provider of one of the services that, in other words, you're selling one of these investments and earning money, you don't fall under any scrutiny of securities laws licensing.
So if you are an investment sponsor and you want to use this as a vehicle to bring people to you, then you need to write your operating agreement such that your fund is the only one that could possibly be selected. Now, if you have an operating agreement that looks really, really funky, you may invite scrutiny. I mean, if it looks and smells to the SEC like you're trying to get around the rules, you may invite scrutiny. But an investment club is going to have a life of its own. You know, once the operating agreement is written and everybody has a vote, it's got a life of its own, and it's got its own survival instinct, and it can make its own decisions. So you may lose control of it. And as a financial professional, I don't care if I lose control of it. I mean, that's what it's there for. But, that said, I mean, my operating agreements are tightly written so that anything the club ends up investing in is going to be something that I put my own money into. I'm not sponsoring the investment. I mean, that's not my goal here.
My goal. Yeah, well, people come to meetings like this, and I think a lot of times we do want to look at ways in which we can get together. Any structure, I think, is valid for study. That makes sense for us to, legally pull capital with non-accredited investors, because a lot of times that's exactly what we're dealing with. So, and beyond simply real estate, obviously. So, we'd be interested. I don't know if you have anything on the operating agreements and so forth, any of the minutia legal documentation, just for review.
Those are the things. That's the secret sauce.
But I don't know.
Those are the things I've paid a lot of money for.
If you got to pay for it.
But I mean, I'm giving you the tools that you need. As a financial professional, I mean, that falls under the the consulting that I do.
Yeah. So, all right. Did you guys any other questions? Do you guys have any questions? He's on our website.
Oh, okay.
Tom, your LinkedIn address is on our green website, or is it? Andrea, can you get that?
It is.
Okay.
You show the last slide before the information.
Yeah, Andrea, could you pull up the last slide? There you go. All right, Tom, thank you. Great presentation. We appreciate it. All right. So
Thank you.
Did you guys all get one of these?
Yeah. No.
Oh, in the packet? Yeah. Yes. You didn't get one yet?
You're not moving. I move? Yeah, you move.
Let me get you.
Everything gets lost. You probably get that big check.
Yeah, I sent you a huge check.
This is going to be our new member folder. Now, this isn't. You're not going to hand this out. You're going to get one of these when you join. You're not going to hand this out to everyone who comes to green. I mean, they're not cheap. This stuff costs money. But the idea, these invitations, this is part of what you guys want to do as you grow green business. Okay. You'll be able to go on our website, learnfromgreen.com. All the tools are available. And you can print this stuff out, or you can order it professionally done. And you got to invite people. That's how these things grow. So this is what I've been asking for a year. It's similar, yes. Okay, yeah. The other thing we have, I'll go ahead and give you this. This is a 3-day guest pass. So anytime you get to these meetings are always free. That's a 3-day guest pass. You can go on with that. You get a password for our online training, and you'll be able to partake in it for 3 days. And so you guys who are members of Green, we're putting these things together for you to build your green business. Our director of membership, Eva Nightingale, will be running Monday online training sessions 11 for everybody in the company. So anybody that wants to learn more about the business, or you're welcome to join that training session Monday at 11. That's every Monday. We have this, now these meetings are always free. We want everyone to come to this. Depending on where you are in life, some people don't have $99 a month. People who are serious can find it. People who really, who want to change things tend to find it. But this thing's going into the next gear. So just so you guys know, the real network marketing is beginning. So all these tools are available. We're going to have this stuff available at the office. You can go ahead and order it, or you can speak to Eva or me if you guys want to get started and have this ready. But really what you want to be able to do is just hand this invitation to somebody. Say, look, come to my meeting. Do someone nice, fresh, clean. Come to my meeting, show up. And that's the best way, because in network marketing, you're making money by inviting. That's what you get. Constantly inviting. And so
Eva's presentation will be recorded.
Oh, absolutely. Yes, and we record everything. Okay. So now we don't make sure. Yeah, I guess that's going to get a bit redundant, but we will have a session. Now, just so you guys know, we did have someone that flew in from Dallas, and along with this, we've got about a 2.5 minute sales video. The idea is if you had met Lloyd before, instead of you come here, but you can also just press a button, play it for your friends. Hey, this is the company. This is what we're doing. So we've been busy, over the course of the last year, you guys have been here. We've been busy just making sure we had enough content and value, but now we're also getting busy making sure you guys can actually have a network marketing business. This is a genuine network marketing opportunity. We want you guys to make money with it. Doesn't happen overnight, but the people that get passionate and start sharing it with their friends, you can start making it happen. We're generally here during the day. What you have with this company is, for all intents and purposes, you can ask Lloyd and Anthony, you have serious professional consultants that you couldn't get for thousands and thousands of dollars for $99 a month, because we have a downline. We've created a mentor-based relationship with people instead of a traditional education system that just wants to take your money, get you in and out of the door. Take your money, get you in and out of the door. We want to grow. We want more people to be a part of this. We want the downline to be 10,000 people. So in that type of relationship, serious players will stay in the game, and then they'll keep delivering information because they want everyone to keep growing. And so we've also found that we're doing deals together this way. This group here is doing deals together. So we're having fun. If you want to sign up, we can sign you up anytime. Lloyd, just let me know. But we're always here on Wednesdays. Just so you guys know, Andrea, say hi. This is Dr. Andrea Molinari. He's our Director of Education. He's in West Palm Beach, Florida. Anyone across the country or even across the world can watch what we're doing here. We simulcast these. And we should be going in Murfreesboro pretty soon, any day now. Jeremy's going to be coming online. In fact, he may actually be getting active with us tomorrow. Cool. And then I think we'll get Franklin online pretty soon after that. And the long-term goal is to be doing exactly what we do here all over the country. I am fascinated with other real estate markets. I think it's really interesting to look at places like Florida. It always fascinates me. Atlanta fascinates me. Memphis fascinates me. And ultimately, when we get to this next level in this company, I want to be going to those places and doing deals with my members. That's fun to me. So anyway, guys, thanks for coming. I want to thank Tom. Tom is one of the trainers. Has some very sometimes it's a bit esoteric because he's got a deep understanding of finance, and it get absorbed a little slowly sometimes.
Yeah, that's absolutely true, Steve. It's definitely the deep end of the pool, but I've found, and I can tell you, I'm not the numbers guy. I'm like the 180 degree from that. I'm the literature guy. And I've found that if you're willing to spend the time with him in terms of reading his stuff, watching his videos, it's really interesting and amazing stuff. He definitely thinks outside the box. For him, as you heard it in that presentation, he's all about safe, reliable investments that are investing at returns that are quite good, actually, without the roller coaster ride that you have with some of the traditional investment opportunities. So it's very interesting stuff. It really is.
So what happens with us in real estate, a lot of us learn how to make some money in chunks, but eventually that path has to take a different trajectory. I think he's 100% correct. I think if I get to a certain point in this game, I'm going to push all the deals to other people. All I want to do is hard money. I don't know why you would. To me, it's just easier business. Now, you're not going to turn down a great real estate deal, but you're not necessarily going to chase those deals all the time either. I mean, once you're probably north of 10 million, I don't know that it's necessarily at least 10 million liquid. I don't know that it takes a while to get there. Obviously, we're going to be doing things to get there, and that people might have that same mindset. If you got $1 million and you're getting hard money type returns, you can make $150,000 to $200,000 a year just on your hard money investments if you are underwriting these things correct. And I can say that is an attainable goal for real people. In not that, if you're concentrating on your finances, trying to get ahead, pretty attainable goal over the course of time. All right, Andrea, thank you. You guys feel free to mingle, talk, give you 20 minutes or so. We like to be respectful of everyone's time, but we stay open a little bit later, so thanks for coming.